Okay, we might get underway. Thank you very much for everyone for attending today's webinar. We've got Joel Knight from Hyperion Asset Management appearing again today. He was with us last year, did a very good job, and we got some very good feedback from having Joel. So before we start, just a quick disclaimer. Obviously, anything presented in this presentation, this webinar, is general of nature. Please seek professional advice before acting upon anything you see in this webinar. Just a bit of housekeeping. If you want to ask questions, and we'll be asking questions to Joel at the end of the presentation, down the bottom of your screen, there'll be a Q&A box. So type your questions in there. Don't use the chat box. This webinar, it will be recorded. So we'll send out a copy of this webinar afterwards. So if you want to revisit the webinar, you can have a look at the recording. Okay, so we have Joel Knight from Hyperion Asset Management. Joel is an investment analyst at Hyperion. He, again, as I said, presented to us last year and did a very good job. So obviously Hyperion had a very tough year, 2022. And today Joel's going to give us an update on what happened last year, where things currently sit, and a bit of an outlook going forward. So Joel, over to you.
No worries, thanks. Lee, if you can, while we're going forward, try and enable me to share a screen. I can get the presentation up. If not, we can
Sure.
work our way through until we do that. Here we go. Got it. There we go. So again, thanks all for joining us today. And I might just start off, recapping on last year and how much of an outlier we think it was, even though it was one of the most painful year of returns that we've had, not just in our global fund that's been running since 2014, but also in our two domestic portfolios, which some of you may have exposure to, that have been running, unitized since 2002, but actually historically go back to 1996. And as you can see on the slide here, it really was one of the biggest outliers that we've had in a very long, ever since Hyperion's been around. When these type of events happen, you really need to go back and have a look at why this occurred. You need to have a real good understanding. Is it our process that's broken? Is it our stock selection? Or is it something else that's somewhat out of our control? And as we stated, I would believe last time we caught up, a lot of the returns for us that we can gather has really come around from interest rates rising from effectively nothing to 350 or 400 basis points, or 3.5% to 4% in a really, really short space of time. We've looked back over 200 years of the US Treasury yields. And US Treasury yields dictate pretty much where everything goes in the world. You can see from 2022 to back to 2020, interest rates rose approximately 540, 550% in effectively, 14 months. Even back in the 80s, and that's when I was born, so I didn't really have a real true feeling of it. But even when you go back into the inflationary spikes back in the 70s, the 80s, we hadn't seen a rate of change this steep ever. And you can kind of see that here on the right-hand side. We've got a rolling 2-year change in US Treasury yields, and you can see it is the largest that we have had ever in time. And then if we can take that a little bit further and have a look back 50 odd years of all equity and bond returns, you can see that in nominal terms, 2022 was a complete outlier, where both fixed interest and equity returns were a complete outlier. And even on real terms, so inflation adjusted, 2022 was still a massive, massive outlier. And a lot of that comes down to the fact that when interest rates rise at a really, really rapid rate, there's a duration effect, effectively, time value of money. So asset prices depress as the discount rate or interest rates rise. And last year, as we've said, has been a really big outlier. But let's move a little bit further from that again as well. So we're a high quality structural growth manager. We're looking for companies that are going to be what we believe, the incumbents or the blue chip stocks in a decade's time, 20 years time, 30 years time. And we have a look at the benchmark of returns now, and because of the way that we invest, we generally don't have exposure to energy, we don't have exposure to commodities, utilities, or traditional banks. And last year, because of interest rates moving so quickly and the war in Ukraine, the only thing that actually gave you any positive return on a sector basis was energy. So this isn't an excuse as to why we had poor performance, but it really is, we think important that you put in last year into context about why asset prices were depressed across the board, not just in the companies that we invest in, but then also on a sector-related basis, how difficult last year really was. But then we have to look forward and have a look at, the companies that we're investing in, have a look at our process and make sure that that's not broken. And so we've had in the global fund, probably about 15 months, 16 months, so I call that a year and a half, of really strong quarterly reports from the companies that we invest in. And, Tesla being one of the most topical companies on the planet at the moment, produced really, really strong full year results for the calendar year 2022. Now, you wouldn't have thought that going into the end of the year in December, where there was a massive capitulation point across all equity markets. And we actually saw Tesla go from around $200 down to $100 at its worst. That for us was complete madness because we had a really good understanding of how well the company was going. Let's have a look and just, have a look at the result and see how good that was. They made $12.5 billion of net profits last year. The year before that was $6 billion. The year before that was $1 billion. They represent 90% of all industry profits for electric vehicles globally. And when we have a look at them, Tesla versus their peers, BYD is producing around 2 million cars per year. Half of them are plug-in hybrids. The other half are pure electric battery vehicles. The gross margin that BYD produces is significantly lower than Tesla. But even on the operating margin, what they use to pay their bills after they've sold their products, BYD is only just getting some operating margin, only just making some money from the cars that they're producing. And then if we have a look to the traditional automakers, your VWs and your Toyotas, their operating margins are still significantly below where Tesla is, but even the operating margin, the gross margin, the operating margins are lower than again. And so there was a lot of talking to the back end of last year and even at the beginning of this year that Tesla had to reduce their prices to keep their cars attractive to others. Now, for us, there's not a lot of basis in that because we know Tesla has a really long order book. And then we have a look at what's happening in the markets globally. Well, in the US, the government came out and said you can get a $7,500 rebate if your cars are below a certain cap. And funnily enough, Tesla reduced their prices to just below that cap. Consumers can start to receive that $7,500. Now, if you think back to 2021, when Tesla started increasing their prices because they were seeing input costs come in, they were passing that on to the consumer. They were seeing their order book blow out from 6 months to 9 and 12 months in some instances. So they raised their prices. So even with the price reductions that they've done in the last 2 months of this year, they are still ahead of where they were in 2021. And we're still seeing that with their really strong gross operating margin. Now, Tesla has flagged that they'll be able to produce and sell 1.8 million cars this year. With those price reductions that I just mentioned, the Model 3 and the Model Y in the US are effectively sold out for the first 3 months of this year. The demand has been so high because of those price reductions. They're becoming competitive with other cars. The Model Y, the base model, is actually cheaper than a hybrid RAV4 in California. They've seen their rate of production or the demand from their cars be twice the rate of production. So it is really getting quite competitive in that space. Now, we would still envisage, Tesla to be able to produce 10 million cars by the end of this decade. And we think that's very, very probable considering that your Toyotas and your VWs are producing around 10 million cars now. And so while Tesla does have a market-leading, market share of around 65% of all EVs sold in the US, we absolutely expect that to reduce back down to what it's roughly now, on par with their global market share of around 20%. But then again, as we move to the back of the decade, to be around that 10 to 15% market share. But the penetration of EVs will rise. So we think it is highly probable that they will get to that 10 million odd cars by the end of the decade. And what we also saw in this full year result was the energy business really starting to come to life. We saw positive gross margin come from the energy division. They deployed the most amount of solar they've ever done. They've deployed the most amount of energy storage they have in their history. And they're slowly starting to get their factories in Berlin and in Texas up to speed. And so as we look forward this year and into next, we'd like to see that energy division continue to grow. And then on Tesla's own emission, the energy business will have scale and be a bigger part of their business than the car will by the end of the decade, which is really, really positive for a company, which was what we believe was unfairly sold down into the back end of last year. And if you had a look at our portfolio, the number of shares that we held in Tesla rose by about 50% at the depths of it. And now that it's recovered, we've sold about 30% of that. And that's really important for us in the portfolio management to be able to produce excess returns over time. But Tesla is just one company that we own out of 21 within our portfolio. And that by and large, and we've come pretty much to the end of the global reporting season, we've been really, really pleased across the board with the companies that are reported. Your Rokus, your Metas, your Palantirs, your Spotifys, companies that were on the cusp of being profitable or break even, have really shown that they're coming forward and producing really attractive results, as is Airbnb. The luxury brand names have really produced some really strong results in an inflationary period. Hermes growing at around 25 to 30%, and the Louis Vuittons and Kearings a bit lower, less aspirational than the Hermes Birkins, etc., but still growing at attractive rates of 15 to 20%. But even some of the advertising names, which we are very cautious of as we potentially go into a slowdown, think of your Alphabets, your Metas, and your Rokus. Even though the advertising spend is starting to slow down, they still produce some pretty attractive results, even though they're lower weights within our portfolio. But if we dig into a couple of results and give a bit more color, Amazon, absolute market leadership in their cloud computing arm, which is AWS. We're starting to see a little bit of a slowdown from that really blasted out growth that we saw of everybody going to the cloud during COVID-19, where they had about 40% growth quarter on quarter for about a year. Now, we expect that to slowly start to slow down to a more sustainable level, and they flagged that, as did Microsoft Azure. But we still expect them to have high teens growth, like 18 or 19% growth in that cloud computing business for the next decade. Amazon also came out and said that 90 to 95% of all IT spend is still on premise. So there's still a lot of white space for that cloud computing spend to go, and Amazon's AWS and Microsoft Azure would be a benefit of that. But really pleasing also out of Amazon was their e-commerce business. Looks like they're starting to get back towards profitability. Now, they had a lot of inflationary pressures on their business over the last few years, but through right-sizing their base of employees and slowing down the spend of their distribution centers, we'd like to see over the course of this year them moving that back into profitability. And we still think that it's going to be a really strong engine of profits and growth for Amazon over the course of the next decade. Spotify, again, a really, really strong result. They got about 500 million monthly active users, which is a really strong step in the right direction. There's hundreds of billions, trillions of people that listen to radio every single day. So there's still a lot of work to be done there as they continue to grow. But they have absolute market leadership in music streaming, in audiobooks. They're getting into ticketing and merchandise now. And so we'd expect over the course of this year and into next year that they move from just being at that break-even level to being actually quite profitable. Spotify did come out and say that they were sacking 600 people of their workforce. That was 6%. We think there could be a lot more in that for a single app company that really only has a single product. Having 10,000 people working for you seems a little bit over the top. So we would expect margins to improve as we move through this year. And ServiceNow, which is a really smart SaaS business that we've been invested in since the beginning of COVID-19. Effectively, what they do is they come in and they do workflow management in your business. So they started off in IT workflow, they moved into HR and also logistics and other parts of your business. The great thing about ServiceNow is they sit on top of your data stack, so you don't have to move all your databases over and integrate into a whole new system. So that keeps the spend on your IT when you purchase ServiceNow down a lot, and also the integration pain of putting new databases together, is also minimized. But the really strong thing that we've seen from ServiceNow over the course of the last few years that has seen it go from about a 3 or 4% weight in the portfolio up to a 12.5% weight is that revenue growth, that subscription growth. So 22%, but if we look in constant currency, that's about 27%. And we expect to see that stay at that level for the next at least 5 years, just on the contracts they have now. And the reason why that's so attractive is their churn rate of customers, and they recycle their customers over, is really, really low, that 1 or 2% a year. So that means that the subscriptions that they have now, there's about a 98% retention rate of their customer base, which means that level of revenue is a lot higher quality than some other businesses out there. And we're really, really happy with ServiceNow. We expect to see them to win new business going forward, and that 22% subscription revenue that they have currently, we could potentially see that grow into the future. But again, as we move forward through this year, a recession has been muted and probably thrown around. And if we do have a recession this year, it's probably the most predicted recession we've ever had. If you asked us in November, December last year, was there going to be a recession? We'd say there was a high probability. But as we've seen the consumer being a lot more resilient and robust over the Christmas and the New Year period, we think that central banks, especially in the US and maybe even here in Australia, might have orchestrated a soft landing. Now, there's no doubt there will be a recession in Europe, but that's probably due to some of the pressures that they have from the Ukraine war and similarly in the UK. But the US, we think, may have just skirted around the fact that they might be able to orchestrate a soft landing. But let's, for argument's sake, say that we do actually go into a recession. What happens to economies during those times? Now, we can see here back to the 1950s, and if you take out the outliers, the median drawback in economic growth on earnings per share of companies usually comes down about 13%. Now, that demand doesn't go away. It just gets sidelined and sits on the side. And then when we do have those recoveries, the recoveries are often larger than what the drawdown actually is. And so for Hyperion, we'd be really happy to see a recession, because the really high rates of organic growth that we have in our portfolio becomes a lot more attractive. The earnings per share growth in the global portfolio sits around 24-25% out over the next 10 years. Now, if we do have a recession, it's not going to be that high. We'd expect it to come down into the teens. But for the broader market in our benchmark that has EPS growth of sitting around 9 to 10% at the moment, we'd expect that to be in the low single digits, and in some sectors be negative. And so while a recession isn't on a relative basis great for the broader economy, we think it is not a bad outcome for us if we do indeed go down that path. And then when we look at our portfolio, how can we still be confident that our companies are still going to be able to produce attractive results if we do have a slowdown? How are they going to produce attractive results into the future? And the way that we do that, we look at the total addressable market that our industries and our companies play in. And as you can see here today, the penetration rate of our companies is still very, very low, around that 4.9, call it 5% mark. And as we look forward, because these companies are growing by taking market share away from their competitors, from their incumbents, because they have something that's a little bit better, their product or service, has sustainable competitive advantages, we'd expect to see them walk into that white space and have about 13% market share in their total addressable markets as we move forward 10 years' time. And so if we do have a slowdown, we still expect these companies to grow. And how we can judge that over time is what we call our business quality score. It's the qualitative work that we do on all of our companies. And as we can see over time, we actually think the quality of the businesses that we have in our global portfolio has improved significantly since 2014 to where it is today. And there's also some key financial metrics that kind of back up those assumptions. Now, the global portfolio is highly profitable. There's only about 3 companies within the portfolio that are at that break-even level. And so we have a really high return on equities, about 33% in the global portfolio. The majority of our portfolio has net cash on the balance sheet. There's only 3 companies that do have debt, and that's Visa, MasterCard, and Spotify, and they have that on the balance sheet for more operational purposes. But even with that, the net interest coverage that they have is 49 times on the EBIT line. So these companies aren't going to go broke. They have net cash on the balance sheet, and the majority of them are insider-led or founder-led, which we think is really important because their interests are absolutely aligned with the virtues of the company that they run. And for the first time since we've really run this fund, we're actually we've seen over the course of last year, the value of the portfolio is dipped below the intrinsic value. So the red line is the net performance of the fund, and the blue line is what we call the intrinsic value or the terminal value. You can track that over time. And we're really pleasing to see that it hasn't actually gone backwards through the company reports that we've seen throughout the course of last year. It's actually stayed the same. And the reason it hasn't continued to go up is we've reduced some of those PEs on our terminal value to reflect the way the business is tracking at the moment. And so for the first time that we've seen in really the history, performance has been under the terminal values. And for us, that's gives us a really strong signal that there is a lot of value locked up within the portfolio currently. We've got a quote here, and we think it is actually quite important, from Benjamin Graham's Intelligent Investor. It basically says, to be an investor, you need to believe in a better tomorrow. So investing isn't about what happened today, yesterday, last month, next week, next month, or even next year. You really need to be looking 3, 5, 7, and 10 years ahead. And if you can invest in these companies that are able to produce attractive returns, that are able to move through some of these cyclical pressures that we've had over the course of this year, and you believe that these companies are going to be the market leaders in the future, you should be able to try to ignore some of the short-term volatility, even as volatile as it has been and as violent as that has been. If you can hold through those periods, then the wise investor, an intelligent investor, should be rewarded. Now, for the rest of the year, if we have a look at inflation, we can definitely see a pathway for inflation moving down to that 3 to 4% mark in coming months. Inflation, as we can see here, really did peak. This is headline inflation, peaked midway through last year to where it is today, sitting just above 6%. And as we cycle through some of the really high energy prices that we saw in February and March of last year, we can definitely see a pathway down to that 3 to 4% mark very, very quickly in the next few months. And then all of a sudden, these deflationary pressures that we've identified over the longer term, lower population growth, lower growth in the economy, that secular demand, higher debt levels, really start coming back into the minds of the marketplace. And we think that once those inflationary pressures start to decrease, and once the growth in the broader economy starts to normalize, those interest rate cycles that we've been seeing over the course of the year aren't going to be 75 basis point increase, 50 basis point increase, not even 25 basis points increase. They'll start to stabilize. And once they do stabilize, the really strong earnings per share growth that we've been able to produce within our portfolio, again, starts to become a lot more attractive. When we think about what's happened over the course of the last 18 months, no one's really been looking at earnings per share that companies have been able to produce, because there's been so much noise in interest rate movements that's really drowned out really, really strong results. So as we move forward through this year, if we can continue to hold these companies, and these companies are able to produce really attractive rates of earnings per share growth greater than that of our benchmarks, we're starting to see what that means for our portfolio. January, we produced around 15% return, about 12% alpha. We've got tonight to go in the US, but we're up about 4.5% in the global fund, another 2% alpha. If that continues through into next month, and then we've got the quarterly reporting season again. So slowly but surely, it's month by month, week by week, we're starting to see these companies be rewarded for their really strong results. And as we said, the internal rate of return, really our internal scorecard of where we see our portfolio is still elevated from where it has been over the history of our fund, 24% per annum forecast out over the next 10 years. So if our companies do execute as we expect them to, they grow the way that we expect them to do, if history is a judge, these internal rate of returns are generally achievable. So I might just pause there, Lee, and go to questions from there.
Thanks very much, Joel. That was a very good presentation. I've got a couple of questions for myself. If anyone's got any questions, just down at the bottom of your screen, if you move your mouse around in the Q&A, just type your question in, and we'll ask some questions. But Joel, in 2022, just describe it in a couple of words.
Horrible.
Would you call that a bit of an outlier year, like a bit of an anomaly kind of thing, or was it something that out of the blue,
it really was. And as I said at the beginning of the presentation, generally, if you look at a share price in any given year, it usually has a 50% volatility, which means its range is around 50%. Now, last year everything was moving in the one direction, and then if you have a look at what happened over the course of the year, there really are, 1 in 20 year, 1 in 50 year, 1 in 100 year, 1 in 200 year events. Last time we had a pandemic was 100 years ago. The last time we had, a proper interest rate right cycle like this was over 200 years ago. The last time we had a tech wreck like this was over 25 years ago. There are massive differences into all of those events. Tech wreck of the early 2000s, that was unprofitable tech. Our companies are highly, highly profitable. They are real businesses. They're not fads. We don't invest in fads like a Zoom or a Peloton or a Beyond Meat or something like that. And then you think like the interest rate move really did catch everybody on surprise. No one, I don't think, would have expected interest rates to go from nothing to 400 basis points inside of 8 months. So you've effectively squeezed a business cycle into 6 to 8 months of the year. And asset prices have reflected that. But as I said, we actually don't need interest rates to go back down. We just need stability, because then you can actually start investing with confidence that those earnings per share will compound year on year on year. And we started to see the result of that the first 2 months of this year.
So the overriding theme was not so much the performance of the businesses, it was purely interest rate rises.
Yeah, and it really was. Like, we can point to, pretty much of all our companies to a fault. There's a couple that did disappoint. There's always 1 or 2 every year that you're not quite happy with. But Tesla grew at about 40% year on year. Airbnb, Spotify, Amazon, Microsoft still growing at really high rates. On a portfolio level, we had earnings growth of around 30%, sales growth of around 20%. It's still elevated from what historically it has been. And that's that business quality score that shows these businesses are getting better and better and better. The businesses in our portfolio are a lot better than what they were before we went into this COVID-19 lockdown and stimulus drive. And they look like they are better than they were at the beginning of last year as well, because they've hung on to their customer base, they've grown their customer base, and they've grown their earnings. The really good thing that we're actually starting to see this year is that businesses and companies, especially the ones that we're investing in, aren't just looking at top line growth, revenue growth. They're actually really starting to put a lot of emphasis on that bottom line, the earnings. And you're starting to see that with the layoffs of 20,000, 15,000 people, with more focus on profitability, more focus on their margins. And we think that's a really, really positive step that has come out of the sell down that we had last year.
And just sort of listening to you, I get the impression that you basically haven't really changed the portfolio a lot. You've kind of sort of stuck to where you are. Is that a fair assumption?
Yeah, it may not look like we're doing much, but there is a lot of portfolio management that happens. Like Tesla's a good example. When that got sold down, we were stepping in, we were supporting our 12.5% weight. So we were buying a lot of shares. And then on the flip side, as it's risen 100% from there, we're selling pretty aggressively into that. We downweighted our exposure to the advertising sector, as when when economies look like they're starting to slow down, advertising spend really contracts and dries up. And so we made sure that the Alphabet exposure, Roku exposure, and even Meta, even though the result was pretty good for Meta, we still think it's prudent to be a really cautious result. If you look historically, Alphabet, which is Google, that's had, probably a 6 or 7 or 8% weight in the portfolio. It's sitting down around 2% today. And we've been able to recycle that capital into something like ServiceNow, as I mentioned, really high quality of earnings that they have sitting in their portfolio. So by and large, there hasn't been any wholesale changes to the portfolio. There's definitely been no changes in the way that we invest, because we do honestly believe that, as unfortunate as the last 12 months have been, it is cyclical by nature. The inflation that we have is transitory, and it is passing.
What would you say? You had a slide before about obviously the different sectors and then the performance returns of the different sectors over 2022, and I think energy was up with 50%. What would you say around that? Your portfolio exposure is probably very concentrated in a particular area, particular technology. What would you say around that? Yeah, well, you want to invest in companies that you're investing in equities for compounding. And if you're there for that reason instead of short-term trading, you want to invest in longer duration companies and companies that are going to be, the absolute market leaders and winners of the future. It just so happens we don't think of them as tech companies. They are modern businesses. They are driving forward change. Software is a lot more prevalent in every business now than it was 10 years ago, and we think that'll continue on. And so when we look at the energy sector and the utilities, we think of them more like an old world type of business. The energy businesses and commodities is a little bit different. You have no control over the product you sell. You have no control of the pricing. You have no control about how easy it is. You're going to dig it up out of the ground, package it up and sell it on. So it's extremely hard to have a long-term view on a mining company. Like, how can you value something in 10 years' time when you have no idea what the price of the product you're going to sell is going to be from one day to the next? So we steer clear from them. And there's also the ESG considerations as well, which is a very core part to how we invest and how we value companies. And so for us, it doesn't make a lot of sense trying to do short-term timings, try to figure out which commodity is going to be in vogue this month, this quarter, this year. We'd much more prefer to invest in companies that control their own destiny by the product or service that they sell, and that have really strong and attractive, growth rates, not just over the next 5 and 7 and 10 years, but even multi-decades. And we've been able to do that throughout our history. And obviously, you talked about energy. I think that's a huge, it's a big talking point at the moment, obviously with renewables. Yep. So I guess you're playing that space going forward. I was listening to some senator in the US talking about how much is this going to cost the US, and they're talking somewhere like $7 trillion. Like it's going to be huge, this whole transition to renewable energy. So I guess in that space with energy, I guess is probably Tesla your sort of play around that space. Yeah, it is. It's really hard to find companies that have the growth profile that we demand, that are working towards a green economy, working towards renewables, that don't have government support, that don't rely on subsidies, or that aren't too mature. So if you think of some of the really big players that will be in that space, like your Siemens, your Samsung Electric, etc., they are effectively mature. Now, they may have some growth in them as this transition spend comes, but we don't think they're going to have that long-term growth profile that we want. And then if you go down and you have a look at some of the more greener plays, without getting into the greenwashing side of things, a lot of these businesses really do need support from governments. They need subsidies. There'll be multiple capital raisings, not just today, over the next 5 to 7 years. We don't want to invest in those businesses that don't have the level of profitability that we have looked through to, and that can't stand on their own 2 feet without massive government subsidies. There's probably people screaming down the line saying that Tesla has massive government subsidies. It's not that much. They had about 500 million in last quarter, and they had $12.5 billion. So on the revenue line, you just think of how small that actually is for something like a Tesla. Yeah. What's your thoughts on, so particularly, we get back to technology. Technology has probably been one of the best performing sort of sectors over the last sort of decade. Is there sort of cycles, like you look back sort of in the early 2000s, it was sort of your resource companies and your banks did quite well, and obviously it sort of come off, and now tech's been sort of the winner over the past sort of decade. Do you kind of think that maybe that there's a, tech in particular, some of the tech might underperform sort of going forward, or you still think some of these companies have still got huge tailwinds that they're still growing at, quite significant rates, which obviously you've pointed to? I guess thoughts on tech being maybe, still the growth engine that's been the past decade?
Yeah, there's a few aspects in that. So if you think back to the early 2000s, and commodities and banks and everything did well, we were in a really large, growth cycle through there. Economies had really outsized GDP growth, leading all the way into the GFC, and that kind of burst the bubble. And then after that, we were in a period of really cheap capital, interest rates going from 7% or thereabouts just before the GFC, all the way down to effectively zero into the teens. And then we had a couple of years of interest rate growth in the US, and into zero again, and now up again to where we are now. But what that period of lower interest rates and cheap capital did was allow a lot of, tech companies and startups and venture capitalists to really, jump on and ride the wave of that cheap money and produce some really good products. But we think where we are today is we're probably past that period of ultra cheap capital. We're starting to see VC companies, venture capitalist companies, not take really attractive businesses to market now. They're effectively aborting them and getting them off their balance sheets. So IPOs that come out of, the money that they had over the last 3 years probably aren't going to be really strong, really mature businesses, because they haven't had time to grow and actually get their products superior to their peers and their competitors. So when we look forward for the tech sector, it's going to be very, very difficult. Growth investing is always really, really difficult, but we think growth and tech investing without profits is going to be pretty much dead. And you've seen that reflected on the NASDAQ over the last 18 months, where probably 60% of the NASDAQ's down over 80%. A lot of those businesses didn't have a pathway to profitability. They didn't have a real product. They're getting caught by costs of capital now. They're going to have to do a lot of raisings. And so for us, when we invest, we want to make sure that that business is real. They have profitability. They have operational free cash flow that's positive. They don't have that. They need to have a bucket load of cash to get them there. But more importantly, they need to have a sustainable competitive advantage. Their product or service has really high levels of utility to the end user. And so if you can identify those companies, then the future is really, really bright. But geez, I wouldn't want to be speculating now if a company's going to be able to make it, because it's going to be, competitive landscape is really tough.
And I guess my final question to you, Joel, is if you had one stock in the portfolio which you're probably the most bullish on, what would it be and why?
You got to look to our top weights there, I guess. Your Teslas and your ServiceNows are really attractive companies. But on the reporting season, we just saw like a Spotify. If they execute, they grow, they get to profitability. Over time, you'll see that company's share price grow significantly. Similarly with Block as well, their result was really, really strong. They came out and said that they've got a true focus on profitability. They're using the rule of 40. They want to grow revenue at around 20%. They want to grow their margins at 20%. So effectively what that's saying is they want to continue growing at a really rapid rate, but do it while being profitable. If they can achieve that, then over the short term, they should become a market darling again. So we're really confident that we have a really good mix of companies. Those higher weights tended to be, the companies that we don't have just the greatest long-term predictability of earnings, but also have in the short term as well. It's a few hands, I guess.
Nice dodging the question, mate.
Thanks. You said no advice.
Well, look, we've got no further questions, but Joel, thank you very much for your time. It was good insight having you on today's webinar. I really appreciate your time and your effort you put in today. So we're recording this webinar. We'll send out a copy of the webinar after this presentation. If there's no other questions, Joel, thank you very much again for your time. Appreciate it. And thank you everyone for participating in this webinar.
Thanks a lot, guys. Cheers.
Thank you.